what are the main drivers behind IFRS 9?
There were a couple of criticisms before the introduction of IFRS 9. One of the criticisms was that the two largest accounting frameworks, US GAAP and IFRS, were divergent from each other, and obviously the financial crisis exacerbated the pressure to come closer to each other. And the other was a criticism of the predecessor to IFRS 9, in other words IAS39, across a number of its facets. One of them was with respect to classification and measurement. The classification and measurement rules under IAS39 were considered to be a bit complex to apply and involved quite a bit of judgment. Another criticism of IAS39 was that when it comes to impairment, there was what was called an incurred loss model. In other words, provisions wouldn't be recognized until there is evidence that a loss has been incurred, whereas in reality, when one prices instruments, that price implicitly reflects expectations of losses incurring. And the third large criticism was in respect of hedge accounting. Many entities, perhaps less so funds, but many entities enter into hedge strategies, and these could of course be very complex. And the more complex the hedging strategy was, it became more difficult under IAS39 to actually apply hedge accounting under the financial standards because of a number of limitations to when you could or could not apply hedge accounting. That resulted to a number of instances where there were economically valid hedging strategies, which however could not result in hedge accounting from a financial statement and financial reporting point of view.
How are financial instruments going to be classified and measured under IFRS 9?
Okay, under the new standard IFRS 9, which became effective on 1st January 2018, the financial assets need to be classified into one of three categories. In the case of investments in equity securities, however, there are only two categories. Let me start off with investments in debt securities. So we're talking here about investments in bonds, investments in fixed and determinable sets of cash flows, basically. Such instruments, under IFRS 9, an entity needs to make a number of assessments to determine the appropriate classification. The first assessment is whether the instrument is held for trading. If it is, which could very well be the case, of course, there isn't need to make the other assessments. If there is a model which is held for trading, then that instrument will have to be classified at fair value through profit or loss. How do you apply fair value through profit or loss is best answered by looking at the existing models we have today. There isn't any difference from today's standards. In other words, the instrument would be measured at fair value at each reporting date, and any gains or losses would be recognized in the income statement. For all other instruments that are not held for trading, there is a two-level test which needs to be assessed. The first one is the contractual characteristics, cash flow characteristics of the instrument. There is a test which the industry has come to know as the SPPI test. What is SPPI test? SPPI is an acronym for solely payments of principal and interest. And what the standard requires is that an entity assesses whether the cash flows that are due to be paid under an instrument represent solely payments of principal and interest. Principal is what you'd expect it to be in terms of looking at the asset management industry. Principal is the amount issued at origination, at inception of the instrument. And interest is a return, is a compensation for having granted a facility to a counterparty. The one key thing that needs to be assessed here is essentially whether the principal and interest payments on an instrument represent the payments that would be relevant for a basic lending arrangement. In other words, you could have the principal, it could be a situation, for example, a treasury bill, where there is essentially, or from a legal point of view, there isn't interest payment per se in terms of its name, but you invest at less than the principal amount and then it matures at a higher amount. For example, invest at 95 and it matures at 100 without any implicit interest from a contractual point of view. From an accounting point of view, that would be equivalent to an implied interest rate which is embedded within the instrument, and that would be fine, it would meet the SPPI test. Interest could be linked to a reference rate, and it could be a fixed rate as well. So fixed or floating rate instruments, by definition, would not preclude them from meeting the SPPI test. So what would fail the SPPI test? A number of the existence of a number of features could make an instrument fail the SPPI test. For example, where the return on an instrument is linked to an index or linked to the performance of an equity or a commodity, where the interest rate, the return on an instrument, is linked perhaps to an inverse floater situation, where the interest rates are inversely moving in comparison with market rates of interest. There could be situations where there is leverage involved. So, for example, the interest rate on an instrument is linked to a reference rate, but it's a multiple of greater than 1 of that reference rate. So, for example, 1.2 times LIBOR or Euribor or any other reference rate. Each of these types of features, including other features, for example, convertible features, where a loan, essentially a loan, could be converted into shares, and instruments which have embedded derivatives in them. A conversion would be one such example of an embedded option. Any such features are not reflective of a basic lending arrangement, and these instruments would all fail the SPPI test. The SPPI test is carried out at an instrument by instrument level. What happens if you fail the test? If you fail the test, the implication is that that instrument must be measured at fair value through profit or loss. The second test that needs to be carried out is an entity-specific test. This test is the business model test. In other words, what is the reason, what is the business model objective of entering into a portfolio of investments? This test is carried out at a portfolio level, so the specific intentions for an individual asset are not really relevant. What is relevant is the objective for a portfolio. IFRS 9 looks at it as there being 3 possible portfolios. One portfolio is the hold to collect portfolio. The hold to collect portfolio results in measurement, provided the SPPI test has been passed. It results in measurement at amortized cost. What is a hold to collect portfolio? A hold to collect portfolio is where the objective of the entity is achieved by holding the instrument to collect contractual cash flows. In other words, the principal and interest which we discussed a while ago. Essentially, the concept is not too dissimilar to the held to maturity classification under IAS 39. However, there is a major difference in that under IAS 39, the assessment was made on a specific instrument by instrument basis, whereas under IFRS 9, it is made on a portfolio basis. Being the overall objective for holding a portfolio of investments, one would expect that the objective does not change often, and one would also expect that it is set at high levels within any organization or entity, basically at the level of the board or the key decision makers of an entity, given that here we're talking about strategy, we're talking about what is the purpose of the entity holding this portfolio. If the objective isn't hold to collect, in other words, one of the requirements for hold to collect is where sales from within the portfolio would be expected to be infrequent and insignificant, then one should assess whether the objective is what IFRS 9 terms as hold to collect and sell. This is another business model where the objective could be achieved in one of 2 ways, and that is either holding the instruments or selling the instruments. Therefore, cash flows from the original investment made by an entity could be recovered either through the collection of principal and interest, but they could also be recovered through the sale of the instruments. In such instances where an entity meets the hold to collect and sell model, then the accounting result is that those instruments have to be measured at fair value through other comprehensive income. The application of fair value through comprehensive income is quite similar to the available for sale fair value through other comprehensive income that we previously had under IAS 39, in the case of debt instruments. Later I'll talk about investments in equity instruments, and in that case there are some significant differences in the application of the fair value through OCI route. The third business model is essentially any business model which isn't one of the first two we discussed. In other words, if it is not hold to collect and neither is it hold to collect and sell, then the instrument, the portfolio essentially falls under the third bucket, which is all other portfolios. It would include held for trading, which I mentioned earlier, and all those instruments, all those portfolios which do not fall into one of the first two business model objectives will have to be measured at fair value through profit or loss.
Okay.
These would include under IFRS 9 any situations where we mentioned earlier under IAS 39, if an entity is managing and monitoring instruments on a fair value basis, under IFRS 9 these instruments would need to be classified as at fair value through profit or loss. The IASB had clarified this in the implementation guidance that such an instrument, such an objective would fail to meet the hold to collect and the hold to collect and sell business model objectives. So from the point of view of entities in the asset management industry, to the extent that they were previously classifying investments in debt securities at fair value through profit or loss for the reason of held for trading or for the reason of managing and monitoring on a fair value basis, one would expect that they would continue to classify these investments in debt securities as at fair value through profit or loss. IFRS 9 does also include a situation where if there is an accounting mismatch, which we discussed earlier, you may also voluntarily measure instruments at fair value through profit or loss, even if the business objective and the SPPI test would suggest otherwise, would suggest a different classification. You're allowed to voluntarily override the default treatment that you would have ended up with based on the business model and the SPPI tests. Moving on to investments in equity securities. Investments in equity securities under IFRS 9 must always be measured at fair value. The default treatment is to measure them at fair value through profit or loss. In other words, all gains or losses are recognized in the income statement. However, to the extent that investments in equities meet certain criteria, an entity may elect to classify those investments at fair value through OCI, through other comprehensive income. There are a couple of key considerations that one needs to be made over here. First of all, not all investments in equity may be classified in this fair value through OCI alternative. For the election to classify an investment in an equity instrument as at fair value through OCI, it is critical that the instrument which has been invested in, the investee, meets the definition of equity in its entirety. Now, the main implication of this, perhaps to the asset management sector, is that if you have invested in puttable instruments of a fund, in other words, redeemable units of another fund, then those instruments, by definition, meet the IFRS definition of a liability rather than of equity. And because they don't meet the definition of equity in its entirety, then they do not qualify for this election. Therefore, investments in redeemable units of a fund must be classified as at fair value through P&L under IFRS 9. Another consideration that needs to be made in respect of the fair value through OCI election, which may be made for investments in equity securities, is that it differs very much from the available for sale model for investments in equities that we had previously under IAS 39. There are two major differences, and one is perhaps a result of the other. The difference that I'm talking about is that on disposal of an instrument which has been classified in this way, the amounts accumulated in OCI in the reserves, provided that we're talking about investments in equity securities, are not reclassified to profit or loss as a gain or loss on disposal. That treatment was the treatment under IAS 39, but it changes completely in IFRS 9. Specifically, any amounts accumulated in the reserves are transferred directly to retained earnings through the statement of changes in equity, but do not feature as part of gains or losses on disposal, and they do not feature in profit or loss for the accounting period. As a side effect to this, and perhaps the trigger to requiring this treatment from an accounting point of view, is that the concept of impairment of equity instruments no longer exists. And that means that whereas before there was need for that highly judgmental decision and consideration on whether a decline in value is significant or prolonged, that judgmental consideration no longer needs to be made under IFRS 9, because the concept of impairment of financial assets, which are equity instruments, no longer applies, given that no amounts will be transferred from the reserves into the income statement.